Good morning. Today we're live on YouTube with our live webinar, and this week we're discussing how capital gains tax can become inheritance tax if you don't plan ahead. For expats living and working abroad, one of the reasons that they might choose to leave the UK is for inheritance tax or capital gains tax reasons. It's great to live abroad. It's the sun, the sea, the sand, and it could be to work abroad, or it could be to live abroad. It could be to invest in a holiday home. Looking at it from the perspective of a UK expat, if you've built up a business or a property portfolio, then when you stay in the UK, you have potential capital gains liabilities on the assets and the wealth that you create. When you go abroad, those capital gains taxes don't necessarily apply. We discussed that in previous webinars. So if an expat lives outside the UK, or they leave the UK and then they sell business, or they sell investments, or they sell crypto, then those capital gains from those disposals of a business, of crypto, of investments, or other intangible assets are still subject to UK capital gains tax if that's where they arrived. But the other consideration is that they're deferred for up to 5 years. So if you go expat and remain expat for 5 years, that capital gains tax liability falls away. Now, capital gains tax on UK assets is somewhere between 10 and 20% for crypto investments or business sales. You can get entrepreneur relief at 10% if you built up a business over many years. But if you go expat, that can be deferred and all that can be paid away. It's a slightly different position with property because the rules on property have changed over the last 5 to 7 years. All UK property, whether it's commercial or residential, is liable to a capital gains tax liability. There's an exception with your main residence, and for expats, that needs to be taken as a separate step to make sure that it's your nominated property and the capital gains tax allowance is forgiven. Otherwise, capital gains tax on property in the UK is somewhere between 18 and 28%, which can be quite a lot of the gain. Now, the gains were reset. They're not indexed, but they were reset depending on the type of property to 2015 or 2019. But those capital gains are there. Even if you go expat, those capital gains are still paying. And that's the subject of a previous webinar. Go back and look at our website at productpartnership.com and look at the series, and you can view those. Some of them are exclusive to our retained clients at productpartnership.co.uk. Join us as retained client, get exclusive consultant reviews and advice online about living and working abroad as an expat. So the UK property capital gains can't be avoided even if you dispose of it abroad. There's a way to change that, and again, we'll cover that elsewhere. But even property that's moved from an individual portfolio to a company portfolio in the UK is still subject to stamp duties and capital gains on that transfer in there. So if you want more advice on that, contact us in a different way. So any investment, whether it's property, investment, crypto, or you built up a business in the UK, is subject to a capital gains tax at up to 10, 18, 20, 28% in the UK. And that doesn't go away unless you relocate overseas and stay as an expat for 5 years, or you die. And when you die, your capital gains tax liability on UK assets all disappears, and it becomes inheritance tax at 40%. Now, there are a much bigger personal allowance on inheritance tax, but 40% still on worldwide business, property, investment, and crypto assets. So it becomes a very great liability. So everybody who's built up a business, built up a property portfolio, built up an investment or a crypto portfolio, that wealth is subject to a liability for all UK assets that are owned, whether they're owned by somebody living in the UK, somebody who's a UK expat, or whether it's an expat owning those assets in the UK. Still subject to UK inheritance tax on those UK-based assets. So there is some planning to be done there to protect those assets overseas. Now, just because why is the inheritance tax still applied? So you can forego and defer and avoid the capital gains tax if you are go expat on investment in crypto and business by going abroad and staying abroad for 5 years. Why can't you avoid the inheritance tax? Well, that comes down to your domicile. Domicile is not the same as tax residence. As we keep saying, you can be tax resident in another country, but you're still from a different place. So if you're from the UK, then you're still liable to UK inheritance tax on your worldwide income. Even if you're not domiciled to the UK, you're still liable to inheritance tax on your UK assets. So if you've got a small UK holding below 325,000 and you're not domiciled, then you can pay zero inheritance tax, but you still are going to need that tax clearance on your estate when you die. And that's, again, it's cross-border, it's an administration in each country. Don't forget, any expat in the EU, under EU law, the administration of the worldwide estate has to take place in the country in which you're a tax resident. So any expat living in any EU country has to declare their worldwide assets. So if you've got property in Cyprus or Malta or Gibraltar or Portugal or France or the UK or Ireland, you have to have a probate administration and tax clearance in each jurisdiction. So you come back to the UK assets, a UK property in central London could be worth $1 million. And if it's not your own or main residence in the UK, and it's not classified as such by HMRC, there will be an inheritance tax liability. And even with the allowances on a £1 million property in the UK, that could still be £200,000. So it's a very heavy liability. 400,000 for every £1 million of assets in the UK, whether that's a business asset, crypto, investment, or property on your worldwide assets. So it's something to consider and plan ahead. Can you avoid it? Absolutely, to a degree, but not absolutely. There's going to come a time when you need to take action. And the best time to take that action to avoid inheritance tax, in fact, the only time you can really take action to avoid inheritance tax is while you're alive. If you do nothing and you're married, you can pass on your allowance to your spouse, but then your spouse still has to deal with that. Your children still have to deal with that. You build up the liability for your children to deal with. So the only time that you can plan to avoid capital gains tax or inheritance tax is during your lifetime. And that's the work, and that's the product know-how that we adopt with our clients that are living and working abroad. So your domicile is a key question. And if you're not sure what that is, contact us. We offer a free review for all clients, which you can book online at productpartnership.co.uk. So what do we offer? What can we do? Obviously, you have to make a family and a business choice and a business decision. tax planning is about family first and business needs, not just about saving tax. But if you go expat, then you can defer and avoid capital gains tax, but you still, as a UK expat living abroad or an expat owning UK assets, you still have, because of your domicile, an inheritance tax liability in the UK. How can you do that? You can live abroad for a long time. So generally, there's some technical details, but generally the principle is 20 years to change your domicile to your new country. So if you relocate as an expat from the UK to Australia or New Zealand, for example, you're an expat. Generally, we consider expats to be like 5 years, because after 5 years under international law, you can adopt a permanent residency and a permanent residency visa in any jurisdiction. Citizenship comes sometime later for countries like the UK and Ireland after 5 years. For other countries like Cyprus, it's 7 or 8 years. And for other countries, it can be longer, 10 years or more, if at all. So changing citizenship or establishing permanent residency generally moves you away from being a short-term expat, but you're still domiciled to where your home country. And to change a domicile, you can go through lots of expensive machinations, but the UK taxman will not make a determination on your domicile until you're actually dead. And they do that tax assessment, so they can still undo that. One famous piece of case law for inheritance tax was somebody that left in his will that he wanted to be buried in the UK. If you relocate to the UK for burial even, that's still deemed that you look at your domicile as being the UK, even if you've lived in Australia or New Zealand or Cyprus for 20, 30, 40 years. So just relocating in itself doesn't necessarily protect you from that, but that's the minimum that you need to do. For Cyprus expats, they've got a wonderful system of a non-domicile status where you can register with the Cyprus tax office. Once you've got your residency permit, once you've got your tax residency, you can register with the Cyprus tax office to be non-domicile, and that gives you 0% tax on your business dividends, your investment dividends, and any capital gains tax and in interest during your lifetime. So, for 20 years while you're non-domicile. After 17 years as a Cyprus tax resident, during a 20-year period, you become Cyprus domicile, and that benefit disappears. So you've got a domicile to Cyprus for a non-domicile status for Cyprus for at least 17 years continuously, or 17 out of 20 years. But that then confirms you've been domiciled to the UK, if that's where you're from, or your home country. So great tax benefits for an expat. You take your business, you become individually a Cyprus tax resident, you draw your dividends from your company and pay zero tax for 17 years, but you've still got the inheritance tax liability. You can avoid the capital gains on the disposal of your business, invest that money in crypto or other investments, and have interest free for 17 years as a retired expat, or having sold your business and becoming, and it's still liable to UK inheritance tax. So what can you do? What is the next step? Obviously, making a will is one thing. You can make gifts, which is another step forward. But if you give your wife, your spouse, the personal allowance, they still got to distribute it on their second death. Now, the thing with assets is with wealth is normally people don't want the wealth. They want what the wealth will give them: the house to live in, the boat to sail on, the investment for income, the pension for income, the business for income. So you want what the asset will give you, not necessarily to own the asset itself. And this is the essence of the planning. As we mentioned with property earlier, you can't now move a property portfolio from a personal to a company holding without having a capital gains and stamp duty assessment in the UK. But you could still build up that portfolio in a corporation. If you have an offshore company, or you operate a separate business company for your investments, so it's a family company, it's a family trust arrangement, then that has a separate tax residence. So your trust or your family trust or your family company can have a separate tax identity, which can be resident in a different location to you. And also it can avoid inheritance tax. So by gifting, when you gift for inheritance tax, you've got a lifetime 325,000, but you can gift that and that falls away. So you've got potential exempt gifts that you can give of 325,000. So if a couple do that every few years, you can build up a portfolio in a family trust or business or corporation or foundation arrangement that it gives you a separate tax resident, gives you the freedom to live and work where you want, whether that's abroad or return to the UK, and protects those family assets in your own family investment business to protect it against the inheritance tax during your lifetime. So there is a cost to that. If you haven't got a capital gains tax liability or inheritance tax, you won't necessarily make those arrangements. You would make a will, because that would save you the cost and delay of probate potentially. But expats living and working abroad have to make a will to settle their affairs in the country in which they're tax resident and the country in which they've got assets. So there's something to be considered all the way round to make sure that you protect family and business, and the inheritance goes to the family and not to the taxman. This is where Proact Know-how comes in. You can contact us at proactpartnership.co.uk and register as a retained client for online advice and free reviews and consultant reviews. Or you can contact us at proactpartnership.com to organise a consultation and enable us to review making a will and protecting your assets, whether that's a property, investment, crypto, or business assets for UK expats or people investing in the UK or the EU. We've got the know-how and the expertise. So contact us and find out more and find out about our exclusive services that we've got available. Thanks for listening to this webinar. We hope you enjoyed it. There's a further webinar in the series next week. So why don't you join us then and find out more from living and working abroad, proactpartnership.com. Thank you.